All right, let me make sure that the audio is working good. But if you're just joining in, big news today. So the audio sounds pretty good. So welcome to this special live stream session. Amanda, am I super fired up to talk about today the big news about the Federal Reserve's decision with the rate cut in less than 1 hour at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. And we're also going to get the latest summary of economic projections or SEP coming out at the same time. And as always, I have my favorite channel ready to go, Bloomberg Live. And this is also being live streamed in my private group. So if you're interested in joining my private group, you can visit firesection.com/community. And Jerome Powell is also going to have a press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time. And we definitely want to hear what Jerome Powell has to say about today's decision to cut rates by either 25 basis points or 50 basis points, and how the Fed is moving forward in the next two meetings in November and December. And if you're watching this on replay, I'll be sure to leave chapters in this video so that you can navigate your way around the live stream. And this is going to be a massive one. And just to give you an idea of how this live stream is going to go today, I'm going to talk about what we should expect today. And then I'll talk about what you should do with your cash when the Fed starts cutting rates today, November and December. And how is this going to affect your mortgage rates if you're looking to buy a house? And I'll answer some Q&As before they announce the decision in less than an hour. And I'm also going to watch what Jerome Powell has to say at the press conference. And that's going to be at 11:30 or 2:30 p.m. Eastern Standard Time. And just let me know in the live chat where you're watching this from. And I appreciate all of you guys hanging out with me. And again, I'll make sure to leave chapters in this video if you're watching this on replay. And the labor market is going a little, well, not a little, but this is going to be the complete focus today. And this just came out last week from the Bureau of Labor Statistics that 7.67 million jobs were open at the end of July, and the expectation was 8.1 million. So it was a lot lower than what economists had predicted. The JOLTS, if you don't know what that is the Jobs Opening and Labor Turnover Survey, which is a lagging data to the labor market. And what's troubling is that the labor market has now cooled down below the pre-pandemic level, and nobody in the government wants to see the labor market continue to drop at this rate, right? And I'm not trying to fearmonger anybody, and I never do that on my channel because I'm just reading what's written in the data. But layoffs have increased to 1.76 million, which is up to 202,000 from the month prior, and total separations jumped by 336,000, pushing the separations rate as a share of the labor force up to 3.4%. But the hiring portion also rose up 273,000 on the month and putting the rate at 3.5%. So if you look at separations here, it includes quits, layoffs, and discharges and other types of separations. The rate of layoffs have increased, especially in the food sector, finance, and insurance. And when it says other separations, it means that people have separated from the workforce due to retirement, death, disability, or transfers to, say, other locations of the same firm. And some economists are suggesting that the labor market is not at the 2008 or 2009 level when people start to lose their permanent jobs. And they're calling it more of a crack in the labor market rather than a rapid deterioration. And however, this is a big however, this is where the Fed needs to be extremely careful with this. Inflation is one thing, but rising unemployment is a completely separate issue that could take a long time to recover from. The data is one thing, but consumer sentiment is also another. Many Americans don't feel financially safe right now. Some airlines have a hiring freeze, and some tech companies have completely stopped hiring. And people are no longer quitting their jobs like they did in 2022 and 2023, which means that they're feeling a little bit less secure about finding another job if they leave their current one, right? Their current unemployment rate is at 4.2%, but that could easily climb to 4.3, 4.4, and then to 4.5, possibly by the end of 2024. And there's a lot of speculation about government data right now. And I don't blame people for doubting what they're publishing. The government has already made a mistake by over-reporting 818,000 jobs, and that's not a mistake that should be overlooked. So are we really at 4.2% unemployment, or is it much higher than that? And I think the Fed needs to cut 50 basis points today and put inflation on the back burner to do something about the labor market right now, okay? And we're going to have a softer labor market here during and tighter consumer spending heading into the holiday season. And US retailers are expected to add 520,000 new jobs in the final quarter of 2024 compared to 564,200 in 2023. So job gains are falling and consumers have tightened their spending. Even with the rate cuts today, I still think there will be a weaker economy going into the holiday season. And Q4 is from October 1st until December 31st. So employers like Walmart, Target, and other major retailers will start hiring seasonal workers in October and November to meet the demands, but they could always make adjustments if they don't have enough sales or customers going to their stores, right? And the other possibility, like this article says, is that retailers may not be able to fill their seasonal positions depending on the locations. And if that's the case, then we could see a lower position filled with employers cutting their positions eventually. If you don't get enough sales in October and November, they could very well cut those positions by, say, mid-December. The forecast for these holiday hires is the lowest since 2022, and it is the second lowest since 2009 when it was 495,800. And the other contributing factor is that most shoppers will go online to buy holiday gifts instead. So fewer and fewer consumers will shop at the stores during the holiday season every year because it's much easier to just get on Amazon and purchase Amazon and get Amazon packages shipped to their recipients, right? So the market is already pricing in that there is a 100% chance that the Fed will cut rates today. But the question is it going to be 25 basis points or is it going to be 50 basis points? And we're going to find out about the Fed's decision in about 50 minutes. Now, this chart keeps changing, and you can type on Google search CME Group Federal Reserve target rate probabilities. Okay, so if you take a look at this, right now there's a 55% chance that they're going to cut rates by 50 basis points, and then 45% chance that they're going to cut rates by 25 basis points. So if you look at the bottom here, it says 500 to 525. So right now it's 525 to 550 or 5.25 to 5.5%. So they're saying that it's going to cut 25 basis points from 5.25 to 5.5 to 5 to 5.25%. Now, if it's a 50 basis point rate cut, and we're going to get that report at 11 a.m. Pacific Standard Time, then it's going to go down to 4.75 to 5%. Now, there is a higher chance of cutting another 25 basis points in November or 2 days after Election Day, but it's really going to depend on how the jobs data looks between now and November. If the jobs report keeps coming in weaker than it expected, then I wouldn't be surprised if the Fed cuts rates by another 50 basis points. The Fed can continue to cut rates, and they're probably not going to stop until they reach a certain point in 2025 or maybe even going into 2026. We'll find that out in the SEP when it comes out, or SEP stands for Summary of Economic Projections. And the market is predicting another 25 or 50 basis point rate cut on December 18th. And we could end 2024 with 4 to 4.25% in Fed funds rates. So we'll see how this goes. Don't look at this chart and say this is definitive. Nothing is, okay? This is just the probabilities of how much the Federal Reserve is going to cut interest rates. And the investors do look at this. CNBC looks at it. All the Wall Street news, they all look at this and say, all right, there's a probability of 50 basis point rate cut here, maybe another 25, and then maybe another 50 here. See, take a look at that. It just changed again. Now the 50 basis point rate cut probability is at 61%. And the 25 basis point is at 39%. So this is going to be constantly being adjusted. And then we'll find out in about 48 minutes from the Federal Reserve. So this is going to be very, very interesting to find out. Now, and this is the SCP summary of economic projections from the June FOMC meeting. In about 45 minutes, we're going to get the latest version of the SCP so that we have a better idea of how many times the Fed is looking to cut rates for the remainder of 2024. And this is what I want to pay attention to, okay? And the Fed changed the rate cuts from twice in 2024 to just once for the rest of the year for the June SCP. And if I had to guess, they're probably going to change this to 3 times for the remainder of 2024, including today. And Jerome Powell is going to have to explain this at the press conference at 11:30 a.m. And I'm going to be live streaming that as well if you're just tuning in. And the Q1 GDP came in at 1.4%, and the Q2 GDP estimate came in much higher at 3%, or double the GDP rate from the previous quarter. And we're going to get the final estimate for Q2 next week on September 26th. So there's the advanced estimate, second estimate, and then the third estimate for the GDP for every quarter. And I will be sure to put that in the private group. So if you're interested in joining my private group, you can go to firesuch.com/community. And while our consumers spending is up, this is the other thing that's not on this chart, and that's the personal savings rate continues to drop from 3.5% in April to 2.9% in July. And that's alarming because people are still spending more money than they're saving, right? The next one is going to come out on September 27th for the August data. And I wouldn't be surprised if it drops to 2.8 or 2.7%. And like I said, today's meeting will also give us the summary of, you know what, before I get into that, I do want to go into this real quick. So what we want to pay attention to here is the Fed funds rate projection. Okay, so right now it says 5.1% right here. So 4.6 from the March, and then today's for June it was 5.1, and then 5.1 is going to be at the bottom, and it's going to say June projection, and it's going to have the new federal funds rate at the top from the September SCP, and the next one is going to come out in December. So we're going to find out what that says, what that one says, and then what this one is going to say. It might be a lot lower than what it's showing right now. So that's going to be pretty interesting to know. And like I said, today's meeting will also give us the summary of economic projections, or SCP, which will give us a better clue about how many times they're going to cut interest rates for the remainder of 2024 and how much further they'll cut in 2025, what their GDP projections are, and where they think the unemployment rate will be for the rest of the year and in 2025. And if you're especially looking to borrow money in 2025 because you're looking to buy a house, starting a business, or expanding your business, I strongly encourage you to mark your calendar or make sure to get your notifications by subscribing to this channel, by joining my community, again, at firesuch.com/community. And we're also going to have a new president of the United States inaugurated on January 20th. So we could see the last of Jerome Powell for the FOMC meeting on December 18th, which will also come out with another version of the SCP that will give us a better idea of how what the Fed will do in 2025. But anyway, we're going to have the third estimate of the Q2 GDP next week on September 26th to find out if we're going to see any changes of 3% from the second estimate. It could be coming down a lot lower, or it could be a lot higher. And then a month later, on October 30th, we'll get the advanced estimate, or the first estimate of the Q3 GDP. And I'm very curious to find out if we're going to see any contraction at a negative GDP, or are we going to see a very weak GDP with less than 0.9%. And you should also take notes that we're going to have 2 PCE inflation come out on September 27th and October 31st. And we're also going to have another CPI on October 10th and PPI on October 11th. And if you don't know what that stands for, it's CPI's Consumer Price Index and PPI is Producer Price Index to measure our inflation. Okay. And unemployment is what we'll all pay attention to. That's including Wall Street and everybody else. That's going to be on October 4th for the September data and then November 1st for the October data. And I'm debating whether I should start live streaming when they come out with the unemployment data. Let me know in the comment section down below if I should. But we're also going to get 2 more jolts on October 1st and 29th. And if you're just now tuning in, it stands for the job openings and labor turnover survey, which helps gauge labor demand while the unemployment rate measures the supply side of the labor market. That makes sense so far, right? And the JOLTS report will give us a better indicator of a solid or weaker labor market. And we'll see about that. Now, I'm going to try to explain as simply as possible. I know there's so many acronyms and there's so many just acronyms. So if there's something that you don't understand, there are plenty of people watching in the live chat. Just put them in there. And like, what the heck is JOLTS? What the heck is FOMC? Just put it in there and people should be able to help out. And if you don't know, I'll try to answer as many questions as I can. And take a look at the Fed's dot plot. And the newest version will come out today in the summary of economic projections with SCP. And I'm going to put that on the right side when it comes out. And these dots I'm showing you right now come from the June SCP. And these dots I'm showing you, that they reflect what each U.S. central banker thinks will be the appropriate midpoint of the Fed funds rates by the end of every calendar year. Okay. And we're going to get this in March, June, September, and December every year. They don't necessarily update this every quarter. And I'm not sure if they'll keep updating the dot plot every quarter when we get a new Fed chairman in January. Maybe Jerome Powell will stay on, but I highly doubt it no matter who gets elected. Well, I think if Trump gets elected, I'm pretty sure that Jerome Powell is going to go. I'm not sure what happens if Kamala Harris gets elected. I don't know if Jerome Powell is going to stay on. We'll see about that. But I highly doubt that he's going to stay on no matter who gets elected. But anyway, now the dot plot has 19 individual projections, and they're all kept anonymous. And no one knows which official or governor is which dot. And the dot plot was created back in 2011, or no, it was 2012, when the economy was still recovering from the Great Recession, to show a form of guidance for the Federal Reserve. And you also don't want to look at the 2025 dot plots too seriously, because they will change every quarter depending on the economic data that we receive in between these quarters. Okay. And the dot plots from June show that a majority of the Fed officials were looking to maintain the Fed funds rates between 4.75% and 5.5%. When the new one comes out, I'm going to put it right next to this chart right here. And I'm going to guess that most Fed officials will move their dot plots to where the green box is showing at 4 to maybe 4.5%. That's just my projection, okay? And that's going to show 3 rate cuts, including today, at 0.75 to 1.25% in total rate cuts by the end of 2024. And if they cut rates by 50 basis points today, they could very well cut another 50 basis points in November, and then maybe another 25 basis points in December. This could become a reality if the jobs report just keeps coming in weaker than expected. And the 2025 dot plots could also have a big change from where they were in the June meeting. So if I had to guess, they're going to be somewhere around here to lower the rates further. And I could be wrong about this, but I'm guessing that this is going to be coming down maybe a little bit lower than where I have it. And I wouldn't pay too much attention to this. And if I were you, but because we're going to get the latest data in December, and December one is going to show us a better projection of what they're thinking about, and how many rate cuts they're going to have, and where the Fed funds rates are going to be by the end of the calendar year. Again, this is going to be changed every quarter. So don't pay too much attention to the 2025 numbers. That's just from my experience. Okay. So anyway, before we find out what's going to happen in 40 minutes, let me go over, what is it, 40 minutes? Yeah. Let me go over what you can do with your cash, mortgage, and other debts you may have as the Fed cuts interest rates or the first pivot from now until and going into 2025 and 2026. So don't forget to get your free resources by visiting FireStreetChat.com/resources, or you can get a consultation by about your finances by visiting FireStreetChat.com/consultation. So we have quite a few people here, and before I get into the next segment, let me get a sip of water, and I'm gonna give out some free channel membership here. I do this every 2 weeks, so I appreciate you guys tuning in. Where is the free channel membership gift? 76 degrees in New York City. Wow, that's awesome. I was just in DC about a month ago. It was so humid. It's crazy. Yeah. All right, let's take a look here. Yeah, there would be a question if they bumped to 75 basis points. That would be yeah, I would be questioning the same thing if we actually have control of the economy or if there's something that is happening. If we get a 75 basis point, don't be surprised if the stock market actually start tanking until the Fed, until the press conference at 11:30 or 2:30 p.m. And and that's when he's gonna have to justify why it's 75 basis points. But I think, in my opinion, this is gonna be a 50 basis point rate cut, in my opinion. But anyway, um, okay, so wait, hold on 1 second here. All right. So as the Federal Reserve continues to cut rates going into 2025, home prices will likely go up in the coming months. And unfortunately, home affordability will continue to be an issue because people who have a 2% or 3% mortgage rate will most likely stay where they are unless they have to move or they have the cash to purchase their next home. And I don't think the home prices will crash like many other YouTubers say, but they will likely go up in 2025 and 2026 as interest rates continue trending downwards. But also at the same time, don't think that the mortgage rates will come down as fast as you think. The mortgage rates could price in much sooner than the Federal Reserve cutting interest rates. So the rates could remain elevated. Okay. And by the way, I want to throw this in there real quick. I got an email from a subscriber asking me about a video I didn't make. I am not that guy from Clear Value Tax. Somebody was, I don't know, it turned out it was about a video I didn't make, and I had to research, and I was like, I didn't make that video, and it turned out to be it was that gentleman from Clear Value Tax, and for the life of me, I can't remember his name right now. But I just want to make that clear. I don't know why I'm getting emails like that, even about other channels and stuff. But we'll be your moment. But anyway, let me focus on the housing market real quick. If you look at the U.S. housing market, the overall median sale price was 433,000 in August 2024, and it has slightly cooled down right here from at the peak at 442,000, but it is still unaffordable for the majority of Americans. If you look at January 2024, right here, it was about 402,000. The problem is inventory, right? And like I said, people with 2% or 3% mortgage rates will most likely not sell their homes, because why would you sell your home now to get another mortgage for 6 to 7%? Roughly 86% of existing mortgages have rates of 6% or less. So when the mortgage rates drop below 6%, it's going to increase demand for homes. And with a limited supply, we're going to see these home prices go higher. And Goldman Sachs is forecasting home prices to grow by 4.4% in 2025, while Fannie Mae is predicting a 3.1% increase. Personally, I think it's going to be even higher, unfortunately. And I think it's going to depend on the rate of the mortgage rate drop and the rise for demand. And it's also going to depend on the location as well. And if I sort this by nope, not that one, home types, single family homes here, the median sale price is actually a lot higher at 453,000. And this is with a 5% decline in homes sold year over year, and a national average of 30-year fixed mortgage rate at 6.5%. So more Americans are delaying their first-time home purchase because now they need to save more for the down payment. If the median home prices rise to $500,000, hopefully not, by next year, even with a 3% minimum down payment, it would cost you $15,000. If you're looking to make a 20% down payment, that's going to cost you $100,000, right? I'm not saying that this is going to rise to 500,000. I want to make that clear. I just use that number because it's easier for me to talk numbers. Anyway, now there are two additional scenarios in which mortgage interest rates could continue to drop as the Fed continues to cut interest rates. First, I want you to pay attention to the latest inflation rates. When we get the PC inflation and CPI between now and the next Federal Reserve meeting, and we see further inflation drops, rates on borrowing products could also start to fall. And second, lenders could preemptively start cutting mortgage rates if they're seeing signs of easing inflation. So the bottom line is that we could see the mortgage rates drop significantly more even before the next Federal Reserve meeting. So right now, I believe that the mortgage rates are already priced in for today's interest rate cut. But don't be surprised if these home prices continue to rise when they cut the rates, because the demand to buy homes will also surge. Now, take a look at the housing supply side, okay, right here. And if you look at how many homes got sold over the past 3 months, people are still buying homes left and right. And if you look at the number of newly listed homes, it is still 2.4% less than the year before. So again, supply is going to be an issue for a while. With more buyers competing for a limited number of available homes, home prices are likely to rise in the coming months. And remember that a lower mortgage rate reduces the cost of borrowing. Home builders will get a better interest rate on their construction loans to build more homes, but that's not going to be fast enough to build up the inventory. Home buyers will also see that the interest rates have dropped from, let's say, 7.5 to 6.5%, and possibly to 5.5%, or maybe even lower than 5%. This will bring down their monthly mortgage payments, which will make borrowing money much cheaper than the year before. The supply and demand will also depend on the area. The housing market in Las Vegas, where I am now, will be entirely different from the housing market in, let's say, Tampa in Florida. And if you didn't know this, the mortgage rates generally follow the 10-year treasury note, or the 10-year treasury yield. And during an economic stress, you can see the spread between the two widen, okay? And I'll save that for a separate video for another day, so it doesn't turn into a 4-hour live stream here. But anyway, so be sure to subscribe if you haven't done it already. But anyway, a decline in mortgage rates will also help the sellers, because they'll be able to raise their home prices, which help them get more equity of their homes. And according to the St. Louis Federal Reserve, U.S. homeowners right now have more than $32 trillion in home equity. And 60% of homeowners have at least $100,000, while the average borrowers sit on roughly $214,000 in equity. Let me know in the comment section down below how much equity you have in your home. In my opinion, there could be a surge in demand like we saw in 2020 and 2021, when the Fed funds rates, let's say, come down to about 4%. Just as anyone who's been looking to purchase a house or an investment property, they're going to be happy to see anything below 5% or maybe even 4% at this point, okay? And no matter what you're doing, you need to make sure to do the following before you buy a house. Let me go ahead and zoom in on that. You need to first make sure that you are completely out of high interest debt. And this is the common mistake that I have seen with people I have talked to, people I have consulted in the past. That includes your credit cards, personal loans, and anything else that is going to hurt your cash flow. You don't want to worry about your debt repayment when you add another large debt to your balance sheet, right? And the second thing you need to have at least, this is what I recommend anyway, that would be the 6 months of bare minimum expenses. And how you calculate that will really depend on where you're going to live. I usually just 6 multiplied by my mortgage payments and multiplied by other utilities, transportation, and all that stuff too. And that should be sitting in a high yield savings account labeled as an emergency fund. I can't tell you how many times I had to repair my home because something broke. I had 2 toilets broke on me. I had one toilet break upstairs about a month ago, and then the toilet bowl just cracked downstairs and just flooded the entire house. That was a pain, and that excuse me, and they can cost hundreds, if not thousands of dollars to, let's say, repair the HVAC unit, fridge, washing machine, garage door, and many more. And then the next thing you need to assess is how much home you can actually afford. And I've been following the rule of 25 for a while. Excuse me, sorry, man. And that's to maintain my mortgage payment at 25% of my income. Okay. So when people ask me how much can I really afford my home, well, is it 25%? If I make $5,000 a month, then my mortgage payment should not exceed more than $1,300 a month. And I know that sounds insane, but math is still math. I can just hear the comment section go crazy with that, what I just said, because of the home affordability. But if you go above 25%, you're not going to have any room to invest for retirement, save for a vacation, or save for anything else that you need or want. If you need a stronger or a bigger down payment, then you need to save for more money. You need to be patient and make sure not to become house poor, because becoming house poor is a real thing in this country. I can't tell you how many people I've talked to in the past who have paid over 30, 40, or sometimes even 50% of their household income towards their mortgage payments. You cannot argue with math. If you have any high interest debt, you're not ready to buy a house. If you don't have enough down payment to bring the mortgage payment down below 25% of your household income, you're not ready to buy a house. I know that's frustrating because the home affordability is ridiculous right now, but math is still math. And lastly, if you don't have enough cash set aside to be ready for any home repairs, you're still not ready to buy a house. Be different from the mistakes other people made. Be smart about buying a house because it is an expense, not an investment. All right. Let me get some water just real quick. Oh. Oh. Powell doesn't have the balls for 0.5%. Oh, you know what? I probably shouldn't read all the comments. Oh, man. Yeah, sorry. I learned that from my team. It's just like, ooh, maybe I need to be careful with reading all the comments. Some of them are really hilarious. Anyway, all right. So let's talk about the next one. What happens to your CDs in high yield savings account as the Fed continue to cut interest rates going into 2025? So when I first opened my high yield savings account in 2016, the interest rates were about 0.9%. Every time the Fed cuts the funds rates by 0.25 to 0.5%, it's going to lead to a decrease in rates for the high yield savings account and CDs. And those are going to be very pretty much right away. And before you move your cash out of your savings account, you still need to consider having some liquidity. So where is the best place to put your money when interest rates continue to come down? And the bank could preemptively cut rates before the Federal Reserve cuts the funds rates. Okay. And let's say you have a high yield savings account and that's paying you 4.5% in interest, and the Fed cuts rates by 0.25%, then the bank could cut by 0.25 or sometimes up to 0.35%. And it really depends on the bank. The bank could just match with what the Fed is doing to go from 4.5 to maybe 4.25%. If they cut rates by 0.5%, then it could go down to 4% or maybe 4.1%. Just remember that these banks are also competing to retain or attract more clients. So they're going to try and compete and have a higher rate to keep you around or attract more clients. So if you have a short-term goal with your cash within the next 12 months, then a high yield savings account is always a great option. If you have much more flexibility and liquidity with a HYSA over the CDs, because once you put money in a CD, it gets locked in for a rate for a period of time. Now, the rate cuts will also affect the CDs, right? But if you already have money in the CD right now, you're not going to see the rate change until the term is up. So if you locked into a 12-month CD for, let's say, 4.5% before the rate cuts, you're gonna lock into that rate for 12 months, even if the Fed cuts interest rates anytime during the 12-month period. The most common mistake I have seen people do with CDs is that they don't have a clear goal of why they're putting their cash into their CDs. The purpose of a CD is to give your cash a chance to beat inflation with stability and predictability in their earnings. If you put your entire cash savings in a CD, then you're locking away your entire liquidity in the CD. And that's not the right way to do it, no matter what the interest rates are. So, why would people hold so much cash in a high yield savings account or CDs? For me, I will always have 1 month of expenses in my checking account and 5 months of expenses in my high yield savings account as an emergency fund. So I do not want this money invested because I'm going to end up needing it one day for anything unexpected, right? And again, I'll always put 5 months of my bare minimum expenses in my emergency fund with a high yield savings account. And if you're someone who needs more than 6 months of expenses in an emergency fund because you're retired, or then you probably want to look at putting some of that into a CD to get a better rate of return. Remember, CDs give you the highest guarantee returns for a bank account, and CDs had some of the highest interest rates in 2023 and 2024. And I also have 3 other HYSAs. My annual expenses fund is in a high yield savings account because I use the cash within 12 months to pay for anything necessary and expected. And I use the savings account to pay for my vehicle maintenance, DMV registration fee, car insurance, and annual credit card fees. And my discretionary fund is also in a separate HYSA because I use the cash in my discretionary fund within 12 months to pay for entertainment, birthdays, anniversaries, Christmas, and other holidays. And I also have a travel fund because I use that within 12 to 18 months. And if I put any of this money in a CD, it won't make sense, right? Because then they're all going to be tied up for, let's say, 6 months, 12 months. I'm probably going to need it within a month, maybe 6 months or less than 12 months. But when it comes to purchasing let's say, a vehicle, saving for a down payment on the next home, or anything else that requires a sizable cash outlay, I'm going to consider a CD to preserve my capital while guaranteeing my earnings with interest payments from the CD. Especially when the rates are coming down, the CDs tend to have a higher rate. For example, and this is just an example. Let's say I have $50,000 I want to preserve. I'm going to show this. Let's say $50,000 I want to preserve. Okay, then and grow interest in. So I'm going to leave it out of the stock market and put it in a CD to keep the capital safe. So the purpose of that $50,000 is to pay for a down payment of my next property. Just an example here. All right. So as the rates come down over the next 12 to 18 months, I am interested in the 12-month CD or an 18-month CD, which is known as a mini CD ladder. So what I can do is just split my $50,000 into 4 CDs like this. So CD1, so that's what, 12, 5, and then just split it into 2, 3, and then 4, like that, right? So $12,500 each. So what I can do is I can do this for, 6 months, 9 months, 12 months, and maybe let's say 18 months. So this is also known as the mini CD ladder. So that's going to be $12,500 each for each CD. So when each CD matures, I can reinvest the interest in a new CD. Now, you don't have to do all 6, 9, 12, and 18 months. Those are just an example. Maybe I'm going to get a better rate with just the 12 and 18 months so I can split the money between those 2 CDs. Or I can open 4 CDs with 12 and 18 months and just create an overlap between these CDs. And it's entirely up to you because it depends on your goal. And the other one that you should know, it is also called a barbell CD. You know what? I'm going to have to draw this one. So let me see if I can draw. Oops. Can I draw a barbell? terrible drawing. Sorry about that. But anyway, man, this is really terrible. So this is going to be all the short term. Okay. And this is going to be the long term. Don't judge my drawing. I am obviously a numbers guy. So this is, I didn't fail art class, but it was not my favorite subject there. But anyway, so you have one side of the barbell for short-term CDs and the other side of the barbell for long-term CDs. And the benefit of doing the barbell strategy is that you don't have all of your money locked up in a long-term CD. The potential downside of the strategy is that you're going to have to do more work to keep track of every maturity date for your CD. And you can schedule a consultation by visiting fireside.com/community. I'm sorry, fireside.com/consultation, or you can join my community at fireside.com/community there. But anyway, what you want to look at is short-term CDs and then long-term CDs and how much money you want to put into the short term versus the long term. And you want to look at what's called the average rates, right? So if this is paying like, let's say 4.5, and this is just an example, 5%. So the average rate is about 4.75%. But what you want to make sure is that how much of your money is going to be tied up in the long-term CD, because remember, if you take out early, then you're going to end up paying the penalty on it. And this is something that's probably you can access right away. So that's going to be the short-term rate cuts at not rate cuts, but short-term at 4.5%, and take out the money right away. But the other strategy that that is going to be very common to know, it's called a bullet CD. Okay, so it's called a bullet CD ladder. Make sure I write that correctly. So if you're looking to make a big purchase in the future years, for example, you could open a 5-year CD now, a 4-year CD in a year, and then the 3-year CD in 2 years. So you can do 5 years, 4 years, and then 3 years, like that, right? So all of those CDs will mature at the same time with different rates, because you're going to open one up every year. But you're not going to have to come up with all $50,000 or whatever the cash you're aiming to save. But this strategy will give you some time to save more money to commit to additional CDs. So does this mean that you should move all of your cash into the stock market? Not necessarily. You still need to have liquidity set aside. You should never become cash poor. I always have cash to deploy into the stock market, and I never put all 100% of my cash assets into stocks. But if you're looking to get a higher return without putting money into stocks, then you can always take a look at a bond or bond fund. If you buy bonds toward the end of a period when rates are rising, then you can lock in high coupon yields and watch the market value of your bond increase once rates start to come down. And that could be a win-win for you. If you're not a fan of bonds, then the other option is to use the CD ladder like I've been talking about. But again, you need to write down what you're using the money for. If you tell me that you're just looking to save $10,000 in a CD just because you like the interest rate, is not a clear goal. Here's a better statement. I'm looking to renovate my home in 2 years, and I'm looking to spend $50,000 for the entire project. I want to preserve my capital and earn guaranteed interest on it. Now you have a clear, concise goal that is achievable, measurable, and realistic, right? And as interest rates continue to come down, every time the CD matures, the next CD will have a lower rate than the one you had previously. You're going to end up reinvesting the money from a mature CD into much lower rates depending on the term. So just remember that unless you have a specific reason to maintain that cash asset away from your stock investments to safeguard your capital, sorry, you could be missing out on a higher return in something like a broad market index fund. If you're also not being careful with planning and end up putting too much in long-term CDs, you could be hit with a penalty fee by taking money out of a CD way before the maturity date. You need to have a plan and balance between CDs and high yield savings accounts. And I have a purpose for every single savings account I own. And if you don't, then it's time for you to start writing things down. Oh my gosh. I cough pretty good. All right. So the interest rates are going to come out. Well, the decision is going to come out in about 15 minutes. All right. I hope that kind of makes sense with the, I'll go through the questions slowly, but we got about 14 minutes until the Federal Reserve makes its decision. So I'm going to talk about what happens to your debt as the interest rates start coming down. All right. So as the Federal Reserve continues to cut interest rates, what happens to our credit cards, student loans, and personal loans? There are two words I want you to remember when it comes to debt: variable and fixed. We saw 11 rate hikes until they finally paused in July 2023. It was difficult to borrow money on either variable interest or fixed interest, right? So as the rate cuts continue, credit card interest rates will also come down, right? But not as fast as you think they will. So credit card interests, if you don't know this, they are variable interest rates. So credit cards have always been expensive to borrow because banks carry more risk to issuers than secure loans. So if you fail to pay back your credit card, it just goes to a collection agency, and the bank will probably sue you for failing to make payments. But if you fail to make car payments, then they can just take away your vehicle, right? And you're still going to owe money for it. And so let's say you have $10,000 on your credit card balance. Let me write this down. Okay. And this has got a 25% interest rate, and you're going to spend around $2,500 in interest per year, right? So if you carry over the balance, if your interest rate, say, drops to 24%, then it's just going to be dropped to $2,400, or saving about $100 in interest for the year. And credit cards can become extremely predatory if you're not being careful with your spending. And as soon as you realize that you're going to start carrying a balance on your credit card, stop using your credit card immediately. You need to reassess your financial situation by budgeting your expenses. You're spending more than you make at this point. Just because the Fed cut interest rates, it doesn't mean you should now carry a balance on your credit card. And I always recommend that you pay off your credit cards as soon as possible. As the rate cuts continue, you might see more 0% interest credit cards becoming available to you. You might qualify for a balance transfer credit card to give you a year or more without interest accruing on the balance. Remember that you're making a transfer to pay down your debt faster, not to extend the payment plans, right? Now, let's talk about the next one. Your vehicle loans. Your car loans were very expensive for either new vehicles or used vehicles. The interest rates on the car loans follow the path of the federal funds rates, but it's going to take some time to see changes after the rate cuts. How much your interest rates are going to be will depend on your credit scores, credit history, and loan term, and the age of the vehicle. What you want to pay attention to is how much you're paying for your vehicle. Can you truly avoid the car loan that you're trying to purchase? And I always recommend against taking out a car loan, because you're taking out a loan for something that depreciates every year. But I understand that not everyone can afford to buy a car with cash right now. But what you don't want to do is overpay for something that depreciates annually. So treat this vehicle that is going to take you from point A to point B. So if you're looking to buy a vehicle here, and let's say for $10,000 for a used vehicle, and then you need to save 20% of that vehicle price, or $2,000. So you just need to finance $8,000, right? So let me go ahead and write that down. The down payment, $2,000. And I'm going to take out the sales tax. Okay, so that's it. So if you need to finance, let's say $8,000, if you get a 10% interest right now, which is really high for, let's say, 2 years, let's calculate that. Oh, okay. Let's do monthly payment. There we go. Now it's correct. Oh, now I have to recalculate that. All right. So the monthly payment is going to be, all right. So forget it. I'm going to do the real math here. All right. So the car loans, let's say you do $10,000. Okay. So you make a down payment for $2,000. And if you do a 24-month loan term, then that's going to get you, let's say, 10% interest for 2 years. And that's going to be about $370 per month. And if you do it for, say, 3 years, that should be about $260 per month. And let me know if I'm wrong in the comment section. Is it worth paying $100 a month more on the car payment so that you can pay it off in 2 years instead of 3 years? Absolutely. You do not want a high car payment for 6, 7, or even 8 years. It is one of the worst loans out there that will destroy your wealth. Now, this is coming from someone who used to have 2 vehicle loans, all right, back in 2013. Let's say you're already in the mess of a car loan with 6 years and your car is upside down in value. You have 2 choices. You can sell the car and take out a personal loan to pay for the deficit and get a cheaper vehicle, or pay off your current car loan as soon as possible. You can also take this time to improve your credit scores and credit history before purchasing your next vehicle. Going from 10% interest to 7% will just save you about $300 in total interest payments for 2 years. So it's not really going to be worth it to refinance your vehicle unless you have like a 25% interest rate on your car loan and you want to bring it down to 7%, then that would be a completely different story, right? And I have seen that. Some vehicle loans are very, very predatory. And once you have your car paid off, you can put that same amount of car payment towards an index fund that pays you, let's say, 7%, right? And let's say you just invest, do the initial value and then $400 a month, so $4,800 a year, and do for 5 years. And you can go to firesightcheck.com/resources for the compound interest calculator that I'm showing you right now. You're going to have over $27,000 in total value. Can you wait 5 years to pay for a vehicle that you wanted with cash? How about 10 years when it grows to 66,000? Let me see it. Is it 66,000? Boom. Yep, I was right. And I buy a car every 15 to 20 years because it is one of the worst depreciating assets and a necessity for transportation. And it's not something that I like to go out and just buy a brand new vehicle every single time. And a lot of Americans do it. Don't do it. Stop doing it. Okay. Now, and if you have a business loan, personal loan, or student loan at a higher rate, now may be the time for you to refinance. But only if you have the plan to pay it off within the next 24 to 36 months. You have to aggressively pay down your consumer debt to increase your savings rate. How can you save and invest 15 or 25% of your income when your total debt repayments are more than 15% of your net income? Also remember that a Fed interest rate cut will only impact private student loans and not federal student loans. Lowering your interest rates will depend on your credit scores. You should find out if refinancing is a good option for you at the time you're watching this video. And if you have a variable rate private student loan, you should consider refinancing it to a fixed rate loan. All right. Now we got about 5 minutes to go. I just need to drink more water. Let me pull up Bloomberg here while I answer some of the questions that I got on the Q&A.
Sales, strong industrial production. So that should make the case for 25 stronger, not weaker. Obviously, we've gotten some nods towards 50. Those are from voices outside the Fed. I think it would be concerning for the Fed from a credibility perspective if they give the impression that those voices are now more powerful than Fed speakers.
Let me look at the questions real quick. I'm going to mute this real quick. Devo saying betting on the 0.25%. All right. How much you want to bet for it? I think it's going to be at 0.5%. I could be wrong, but all right. We'll see. This guy agrees too. And this person. Okay. This is what that's what I was laughing at, that Jerome Powell doesn't have the walls for 0.5% level. Yeah, talked about the bond market earlier in this live stream. You can always go back a little bit. But yields dropping, that the market price does go up, but we'll see how it goes. I would be very interested too. Corey is looking at 0.5%. Okay. Yep. Yeah. I should probably keep reading before I answer the questions. Companies are buying that. Yeah. Okay. Yeah, I remember when the mortgage rates were really high. I'm a little old too. In my late 30s, if you guys can believe it. I'm aging pretty good, right? You don't have to, just tell me how you really feel. But yeah, I remember that 8.75%. But I have a mortgage rate right now at about 2.9% that I refinanced back in 2021, and I'm really glad that I refinanced, because I'm not going to tell you what my mortgage payments are, because people are going to be pretty upset. I don't know why people get upset about what I share, but yeah, it's just one of those things, right? Like if I'm in my house right now for over, for 2.8, 2.9%. And if I move out of here, then I'm going to log into another mortgage rate. That's going to be probably 6%, maybe a little bit lower. We'll see. And my mortgage payments are going to go up. So most people don't want to do that. And they want to stay where they are. And because the mortgage rates being low, there's a lot of people who want to hold on to their homes now. And it makes sense. And people they don't want to cash out refinance either, because when you cash out refinance, your rates are going to go up as well. So people are really sitting on that $32 trillion in home equity, which is really, really crazy. My spending goals or gross, so always gross for me when it comes to the savings rate. So if I'm making this much money in gross income, I'm gonna save. There's the gross savings and then there's the net savings, because all the cash that I put in to my savings accounts, some of them are going to be taken out. So on my spreadsheet with my private clients, they're going to have a gross savings rates, and then they're going to have the total withdrawals, and then they're going to have the net savings. So if you save $10,000, then you withdraw $5,000, then your net savings is $5,000, right? So good question on that. Yeah, and this is probably going to change, G unit, and we'll see how it goes. But it looks like HYSA rates are going to come down after today. They have been lowering for a while, so it's really going to depend on what's going on. But yeah, okay. So we got 1 minute, and I'm going to just go ahead and turn on Bloomberg here, and I'll answer as many questions as I can.
What do you think about some of these market moves? The fact we haven't even seen a rate cut yet, and we're already at these kind of levels.
I think we've gotten carried away on the fixed income side, both on
bonds more than stocks.
I think bonds more than stocks.
Why is that, Mohammed?
I think stocks, you can make stories for secular changes, for real transformational changes. I think in the bond market, you can't make that argument. If you make it, then you should go the other way, because we have fiscal deficits of 6 to 8%. We have high debt levels.
30 seconds.
The secular argument is
last time
favor in
the website crashed.
Two issues in the last
Federal
few weeks.
Reserve's website crashed. So
we had debt out of Italy,
doesn't.
record order book. The week before, we had debt out of the UK, record order book. We saw some of the busiest days we've ever seen in the high-grade corporate market in America. Tons of demand to back it up.
And when you ask people why, they say there's cash out there and people want to lock in yields before some of those rates go down. I love the story idea that basically you can come up with a story for stocks, but the story for bonds doesn't work logically with where it is right now. And that,
all right, should be coming out now.
If you're storytelling, stocks actually make more sense right now than the story that is the bond market.
What did you say this morning? This is a market where logic comes to die.
Yes.
Isn't that what you said?
Yes, that is what I said.
That's my line of the month. My line of the month. This is the countdown to the Fed decision. It is literally seconds away. Going into it, your scores look like this in the equity market. Firmer,
and the website's
about
crashing.
1/10 of 1% on the S&P 500 on an 8-day winning streak. In the bond market, 2-year, 10-year, 30-year, your scores as follows. Your 2-year yield in America has been moving lower over the last month. Your yield 3.65. Your Fed decision with Mike McKee.
Okay, there we go.
It's 50, and the promise
50.
of another
Let's
50
go.
basis points in cuts by the
Owe me
end
$5.
of the year, and another 100 basis points in 2025, which would put the nation's benchmark rate at 3.4%. It's projected to fall another 50 basis points in 2026, which would put the rate at 2.9%, which is now the Fed's median forecast for the neutral rate. That is up a tenth from June. The consensus is GDP will rise 2% this year, down a tenth from the June forecast. Growth will be the same in 25 and 26. Unemployment will hit 4.4% this year. That's an increase from the June figure. It will fall to 4.3% in 2026. PCE inflation of 2.3% this year falls to 2.1% next year and hits the 2% target in 2026. Though inflation remains, quote, somewhat elevated, the statement says they cut because they now have greater confidence inflation is moving sustainably toward their 2% target, and the risks to inflation and the labor market are roughly balanced. While they do not explain why they decided on a half-point reduction, the statement says the committee is strongly committed to supporting maximum employment. And remember, in Jackson Hole, Chairman Powell said any deterioration in the labor market would be unwelcome. There was one dissent from Governor Mickey Bowman. It's the first dissent by a Fed governor since 2005. It is the first dissent by any member of the committee since 2022. The statement adjusted to say the committee will, as always, carefully assess incoming data, quote, in considering additional adjustments. There's no changes, guys, to the QT portion of the Fed's policy.
Maliki, stay close. We'll come back to you. Here's the price action in response to it. Knee-jerk reaction. It's the first move. Might not stick, but this is the move so far. Up by 0.8% on the S&P 500. The overwhelming outperformance on the Russell. The small caps now up by 1.7%. In the bond market, just bear in mind, we've come a long way. And we've priced in a lot to this yield curve. The 2-year just climbing just a little bit to unchanged at 360 at the moment at the front end of the yield curve. And in the FX market, dollar yen dropping back by about 0.7%. So that's a weaker dollar, a stronger Japanese yen. Lisa, 141 on that currency pair.
Yeah, now over to the Bank of Japan. And if they hike, how much does that divergence continue? I also want to point out gold. You're seeing a bid into gold right now. We start to look for some of the inflation proxies. So will this sort of feed into that idea? I thought it was interesting. The long end of the yield curve. Just on the margins, not significantly, yields just slightly up on this idea that they're going to go bigger and potentially
50 basis point rate cut, if you guys
So the median
missed
dot
it.
can mask some disagreement beneath the surface. So let's talk about the range and not just the median at the FOMC. The median dot for 2025 in the projection materials that were just published is 3.4%. The range for 2025 is anywhere from 2.9 to 4.1. 2.9 to 4.1. That's quite a range on this FOMC. And I think for the first time in a long time, we have some dissent playing out publicly as well. The first dissent from a sitting governor on the FOMC since 2005. This was not a unanimous decision.
And it really highlights why this actually became such a knife's edge kind of decision. Just to add to that, 10 officials penciled in 100 basis points or more of cuts for this year. 9 officials penciled in 75 basis points or less for this year. It actually matters quite a bit for market expectations.
It does. And then you know what? I'm going to show you guys what they just published just now. And I am very, very interested in going through this real quick. And don't pay me. It's just all fun, right? So, you know, I figured it was going to be 50 basis points, and I was right. You know, I get to say I was right. So this is the official Federal Reserve statement. So recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have slowed, and the unemployment rate has moved up but remains low. Inflation has made further progress toward the committee's 2% objective, but remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. The committee has gained greater confidence that inflation is moving sustainably toward 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain. Economic outlook is uncertain, and the committee is attentive to the risks to both sides of the dual mandate. In light of the progress on inflation and the balance of risks, the committee decided to lower the target range for the federal funds rates by 0.5% point to 4.75 to 5%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the blah, 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 blah. Okay, cool. So that's interesting. Okay, so press conference in 25 minutes. I guarantee you, people are going to ask this question. Why 50 today? Are we going to have another 50 in November? Or are we just going to have a 25 in November? I think this is going to be another 50 in November, and this is going to be another, and then probably another 25 in December. So, and I need to calm down just a little bit because I'm getting a little too excited. And when I get excited, I talk a little too fast. So let me go ahead and slow down just a second. All right. So here's the summary of economic projections, or the SEP. So the Fed did grow a pair, like 1957 Portia Speedster said. They did grow a pair. So this is what's changed. Take a look at this. Let me see if I can draw on this. I can't. Why can I draw on it? Draw. Hold on. Nope, I don't want to sign. Okay, here we go. Cool. So take a look at this. Let me see if I can zoom in without drawing. All right. So change in real GDP. This has decreased. So the previous projections show 2.1%. Now it's showing 2.0%, right? And 2025, like I said, don't pay too much attention to this. That's 2%. Now take a look at the Fed funds rates. It is down to 4.4 to 4.6. So 4.9 to 5.4. So we're looking at 2 more rate cuts in November and December, but it really depends on how many more times or how much more they want to cut to. So right now we're sitting at 4.75 to 5.0, right? So they could cut rates 2 more times, possibly to 4.25 to 4.75. We'll see, but this could be wrong, or he's probably going to explain that at the press conference. But if they only cut 1 more rate, let's say in November, this just goes to 4.5 to 4.75. Is that going to happen in November, or could that happen in December? They could skip interest rate cut as well, but they did 50 basis points today. So that means they could just do 1 more rate cut in November, or they go down to 4.25 to 4.5. So we could see a 25 basis point rate cut in November, as well as 25 basis point rate cut in December. So that's what we were just looking for. In 2025, they're looking at 3.1 to 3.6, and they're looking at 2.6 to 3.6 in 2026. So let's take a look at the unemployment. It has increased. So this is what's alarming right here. Unemployment rate. The last one in June was 4.0, and today they're talking about 4.4. Now, next year, this is they're still looking at 4.4 as opposed to 4.2. So it has increased, and this is what everybody at the press conference is going to ask about. How much more? How do you feel about the unemployment rate? Is it going to go up higher? Is it going to be worse? Now, PC inflation. It has decreased from 2.6 to 2.3. And next year, they're projecting 2.1. I think this is going to be even lower, probably to 1.8 or 1.7, in my opinion, for 2025. And core PCE has also decreased to 2.6 and a 2.2. And I'm going to, oh, wow. Okay, US dollar. Got it. Okay. So, sorry, I'm all over the place. But Fed funds rates for right now, by the end of calendar year, at 4.4, and next year we're looking at 3.4, and then 2.9 for 2026. But again, don't pay too much attention to 2025 and 2026. We're gonna get another SCP in December, and they're gonna let us know how many more rate cuts they're gonna do going into 2025. Okay. Now let's go into the dot plot here. Oh man, so it was not a unanimous decision for the Fed governors. So right now, if you look at it for the dot plots, by the end of the calendar year, there's only one person here voted to have it at 4 to 4.25%. But the majority of actually not the majority, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 people voted to keep it between 4.25 to 4.5%. So that's 2 more rate cuts. So that would be 0.25%, or they could just cut it by 0.5% in November and no rate cuts in December. Now, 2 members want to keep the rates where they are at 4.75 to 5%. And then you have 7 people here. They want to keep it at 4.5 to 4.75%. Now, I was pretty spot on with the green box. If you were watching me live earlier, it looks like the majority of them are looking at 3.25 to 3.5%, and another 6 people are looking at 3 to 3.25, and 2 people are looking at 2.75 to 3%. Right now, it's only showing 2 people, but this could very well be the majority by let's say March of 2025. So we'll see about that. And there's one hawkish person here, and then another person that want to stay at the top there. So we'll see how that goes, right? So that's 50 basis points. Wow. Let's listen in on Bloomberg and see what they're saying here.
Is the reaction of a single mandate Fed right now, especially if you believe 2% is your inflation target.
Let's cross over to Dan Swank and bring her in of KPMG. Dan, we'd love your thoughts on the decision, and then we can get into the nuances. What do you make of the 50 instead of the 25?
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about. And Mickey Bowman doing a dissent, Powell willing to take a dissent among the board members as opposed to among a president. That is how much he wanted this 0.5% rate cut. And I think that's very important. I think you're going to see it couched and explained within the context of several participants at the July meeting thought they were ready to go ahead and cut. So this is a bit of a catch up to that. And so that should help temper a little bit this dovish read on it. I was surprised that they kept the risk balanced, although clearly the focus is now on employment and not allowing the situation in employment to become much worse. Remember, we're at 116,000 payroll gains, 3-month moving average as of August. That's not statistically different from zero. Combined with the downward revisions we saw on August 21st, the day before Powell gave his remarks at Jackson Hole, those downward revisions, record downward revisions, even if they're not as large as they appeared because of some immigration that we're not capturing, they're still large. And it means the birth and death rate, the death rate of firms has picked up, and their small businesses aren't hiring as much as well, which could mean actually the payroll data for this year also gets revised down, and that's what they're worried about.
Diane, your work out on LinkedIn has been just hugely beneficial, a really holistic view of the U.S. economy. I have a Dow Jones Industrial Average, bottom of the pandemic, up 128%, 21% per year. I've got debt and deficit that Halbronner and Bernstein never dreamed of. Diane Swank, is this a Fed just dealing with our stimuli? Is this a Fed just dealing with debt and deficit to the sky?
You know, we've had everything you could possibly imagine pushed up inflation, and now we're seeing it come down despite the fact that we still have a lot of debt. So, you know, on the margin, yes, we do have high debts, and I do believe we need to deal with that at some point in time. And I don't think we have anyone who's willing to talk about it on either side of the aisle.
It's so funny. The stock market went up, like it shot up, right? And as they read through all the statements, and then now they're like, wait a minute, now we need more answers on why they're cutting by 50 basis points. So yeah, it's back to the flat or where it was earlier.
That we put a whole year budget into from March into October 1st, you get a continuing resolution at best through year end, and you're going to get more constraints on spending, I think, as we get into 2025. Diane, one reason why this comes as a surprise, this decision, one reason why is because they could have telegraphed this more carefully. There was no data that really moved the needle between the time when the quiet period began and now that would shift us toward 50. Why do you think there wasn't more clear communication that this was a Federal Reserve ready to cut rates by 50 basis points?
Well, frankly, I don't think that Jay Powell, by the time the blackout period hit, had the votes in his pocket to be able to do that. And I think we saw that in some of the mixed messages, even the day of the blackout period. Chris Waller, governor on the Federal Reserve, had said, he'd be open to a more aggressive rate cut, but he didn't seem to be really ready to do it in September. We saw John Williams come out that same day and sort of talking about more cautious rate cuts, more of a quarter point kind of rate cut. So they didn't telegraph it because he hadn't corralled the cats. But this really does speak to the fact that he does have an extraordinary ability to actually do just that.
Let's get to this quote from Neil Dutta of Renmark, just out at the moment. Here's the issue. The balance of risks have changed. In June, most saw balanced risk to unemployment rate. Now, this has completely flipped. Most see risk to unemployed skewed to the upside. This will not be the last time we see a 50, in our opinion. Lisa, your thoughts?
This is basically what's being priced into this year. I mean, how else do they get to more than 100 basis points potentially by the end of this year? And if you think about it, it raises a lot of questions about what they are seeing that suddenly makes that such a consensus, given that we've gotten a lot of mixed messaging.
Let's head back to London and catch up with Bob Michael at JP Morgan Asset Management. Bob, I'm sitting there in cash. I've been sat here for a long time. You've been warning me for a long time that I face real reinvestment risk. The Fed's just cut 50 and I'm freaking out. I give you a call. I'm now worried about another 50 and maybe another 50 after that. What are you buying on my behalf?
We're telling clients, just get into the bond market. Just get into a general bond fund. It could be an aggregate investment grade bond fund. It could be a core plus bond fund. If you're in a high tax bracket, get into a general municipal bond fund. Yields are coming down. Yields are at this level with $6.3 trillion in cash building up and most people not liking the bond market. Some buying has brought it down here. And this money will come in because they're going to watch the return on cash go down like power windows.
I got to say, Mohammed, this goes to the point that you were making. I'd love your comments on this idea that the Fed was seeing something that made him shift his view. And what we're seeing right now is that maybe he just didn't have the votes. I'm just trying to wrap my head around what that means going forward, that maybe they're going to be even more aggressive than the market previously thought, and that maybe it is appropriate to price in.
Well, he was talking about the bonds, why now is kind of like the time to buy bonds. And I'm not telling you to buy bonds, okay? But if you buy bonds towards the end of a period when rates are rising, right, then you can lock in high coupon yields and watch the market value of your bond increase once rates start to come down. So right now, the yields are going to come down and people are buying in. So the yields come down, the market price, the market value of your bond increases. So that's what he was talking about there.
See.
Diane Swank, I got 8 ways to go here. Let's try this. You've got a wonderful reading of America away from 3 zip codes in Manhattan, the quadrants of Washington, D.C. This rate cut, how does it affect America that are not the elites, not the people enjoying NVIDIA to the moon?
Well, this is really important because the rate cuts, the short-term rate cuts are what come through on loans that consumers take out. This is beyond the mortgage rate situation. This also helps the mortgage rate situation, obviously, but the real issue for consumers are short-term interest rates and how they are priced on their debt. Now, on the credit cards, the average credit card rate is about 25%. This is a rounding error on that. It's not going to help a lot on that. That's just incredible how high those rates are. But when you get into auto loans, when you get into other kinds of loans that consumers take and businesses, middle market through small businesses, it affects all those loans. And right now, you can imagine a lot of people are going to get some relief in terms of that. Now, the good news is there's not a lot of overhang of debt for consumers, and they can service the debt they've got. But for those lower income households that have already exhausted all of their savings and then some, this is good news. They rely on lower rates to buy used vehicles. They can't even afford to buy new vehicles anymore. That goes right up into middle income households. So that's where we'll see some movement, but it's not immediate. You're not going to see, the Fed also understands there's lags. And I think Mohammed is right about the issue of the market front running, when the real message here is that this was not signaling that we're ready to cut. This is a window of opportunity to cut now, catch up on July. That's important. But this isn't a signal that they're ready to go 0.5%, sort of continuously. And the election is an uncertainty. That is not factoring into the decision today, but it is an uncertainty in terms of policy for 2025 and 2026. And that could change the trajectory for the Federal Reserve once that cloud of uncertainty regarding the election outcome in the U.S. is lifted.
Could not agree more. Dan, just one of the best as always, the clinic. Dan Swank there of KPMG. November 7th could be a very, very different meeting.
Yeah, and if you guys didn't notice, but the next Federal Reserve interest rate decision is 2 days after Election Day. So it's November 7th. That's when the next FOMC meeting is, and we're going to find out if they're going to cut more interest rates. And Election Day is on November 5th, and so we'll see how that goes.
Matt, your first reaction to this one, please, sir. We get 50.
Yeah, I think it's all about the messaging that we hear from Chair Powell about the reaction function as we look ahead. You know, as we were thinking through if they go by 50 basis points, what is the communications challenge for them? I think it's two things. One, they have to project confidence in the economy, positivity in the economy, so they avoid a negative confidence signal. And then two, I think that they want to send a signal that this is not the new norm, that they're going to be ratcheting down to 25 basis point increments. And as I look at that dot plot and the skew for this year, it does seem that there's a pretty strong kind of consensus around going 25 basis points from here. I think 18 out of 19 dots showed only an expectation of 2 more 25 basis point rate cuts or less. And so I think Powell can paint this as a one-off. It was meant to right-size monetary policy to a lower inflation environment, ensure that the real rate doesn't rise too much, and to really show that kind of actions speak louder than words in providing confidence on the soft landing.
Matt Lozzetti, the 10-year real yield just printed below 1.50. To me, that's a huge signal coming out of the pandemic. What does a diminished real yield do for American business, American finance, and investment?
Look, I think we should expect that the goal of this is to keep financial conditions easy, to ensure that financial conditions don't over-tighten and put a soft landing in jeopardy. That is ultimately the legacy of Chair Powell, and I think that he took out some insurance against that today. I think that's a good outcome for the economy. Hopefully he can message it in that way, which is they have a positive outlook. This is not the starting of a 50 basis point cutting cycle. And I think if you get that, soft landing prospects improve, financial conditions ease, and we have a very good outcome for the economy.
Matt, one of the stickiest areas of inflation has been the housing market. And what we've seen there has been recently an uptick in mortgage applications, as well as just in general, some of the home lender stocks. How quickly could you see a transition from a market that is completely flat on its back, not shifting around, moving at all, to one that is robustly price discovering to the upside with people given renewed confidence by lower rates?
Yeah, we got mortgage purchase applications this morning, and they did show a tick up, more driven by refinancing activity than purchase activity. It does seem to be lagging a little bit, the move in the mortgage rate so far. My own view is I think that's driven by, when you look at the University of Michigan or Conference Board, so many consumers expect rates to come down over the next year. And so that has to happen, and maybe as rate cuts happen and as mortgage rates fall further, that really does unleash activity in the housing market. That would present upside risks for the economy. I think the reality is, Q2 growth was 3%. Q3 growth is tracking near 3% according to the Atlanta Fed GDP. When you look at consumer spending on a 3-month annualized rate, it's the highest that we've had since 2011. We got a robust retail sales report this week. So, I think Chair Powell should present a picture where the underlying economy and fundamentals are resilient and strong here, but they were taking decisive action today to ensure that those outcomes continue.
Hey, Matt, final round before you go. Question for the chairman in this news conference. What's your number one question?
I think it's all about reaction function. So the fact that they went by 50 basis points today before seeing very weak outcomes for the economy will naturally raise questions in the market about what if you get a weaker jobs report? Do they go by 75 basis points or not? So I think it's all about the reaction function from here. And how does he respond to that? Does he kind of set a high bar either for another 50 basis point or even higher rate cuts?
Matt Lazzetti at Deutsche Bank, Bob Michael at JP Morgan Asset Management still with us. Bob, you love asking this one too, so I'll ask it for you. What's your question for Mike McKee in this news conference a little bit later on this afternoon?
Has the concept of an equilibrium, long-term neutral Fed funds rate expired? Do we need that anymore? Shouldn't they be talking more in terms of a real Fed funds rate, maybe minus 1% to plus 3%? I mean, for goodness sakes, in my career, I've seen the Fed funds rate at 0 and 20%. So trying to target something like that is nonsensical to me.
Hey,
Press
Bob,
conference
gonna
in
catch
about
up, as
4
always.
minutes.
Bob Michael at
4
JP
minutes.
Morgan Asset Management. We get 50 from the Federal Reserve. Your news conference is 5 minutes away. The price action looks like this, up 0.5% on the S&P 500 in the last hour. Lisa printing a new all-time high on the S&P.
Which really is in line with what some people were expecting, although disappointment they did not get. If you want to take a look at whether this is a Fed that can outdove market expectations, it seems like they...
Yeah, so the market is confused right now, and I'm sure in the I'm looking at the live chat and the comment section in my private group. The question of why are we at 50 basis point rate cut, right? And the one reason that I am thinking of, and before he speaks, is that it's the labor market. It's weakening. So this is something that they're looking at. Jerome Powell is going to talk about at the press conference is that what they saw, and it was not a unanimous decision. So some people felt like they should have done 25, and some people thought they should just do 50. We'll see how that goes. So it doesn't, to many people, right? It doesn't feel right, and that's how the market is reacting right now. Is that they're like, wait a minute. Something doesn't smell right. I want to hear what Jerome Powell has to say before we put more money into the stock market, because are we potentially going into a recession? Are we going? Is this the labor market potentially going to be worse? And if you join into my live stream from the beginning, at the beginning, I talked about the labor market, the jolts, right? It's coming in a lot weaker. The holiday retailers are already saying that they're going to hire fewer people than they did last year. And this is going to be the second smallest seasonal labor employee hiring since 2009. So this is where people are saying that, wow, we may need to just kind of have to wait until what Jerome Powell has to say, and then we'll decide what we need to do with the money. So.
And I just wonder if it's more difficult to make the decision now on November 7th, now that you've had this initial 50 basis point rate cut, and you have a market that's now saying, yeah, you could do another one in November.
Yeah, and that was the argument all along. Start in July. Don't get yourself in this situation. But it is what it is, and they're now going to have to navigate this. I think Powell is going to be very clear. He'll
switch to CNBC here, and we're going to tune in to the Federal Reserve press conference. Go. No, it's silence. Okay, so Jerome Powell is very, very on time, unlike Joe Biden and everybody else in the politics. It's like, oh man, these guys are always late by 30 minutes, 40 minutes. And but Jerome Powell is very on time, and I respect him for that. We'll see. And it should be happening in about 1 minute, and see how it goes. But again, while you're watching this, get your free financial resources. You have your FIRE calculator, 401k calculator. Go to firestatchat.com/resources, and you can join my private community at firestatchat.com/community. And I have some new products and services coming out next month. And joining my community, you'll get a bigger discount from there. And if you just want to chat with me and have a consultation, you can go to firestatchat.com/consultation. Let me go and switch this real quick here. Should be coming out shortly, hopefully. There we go. You know what? CNBC, it's lagging. I'm going to switch to Bloomberg here. Sorry about that, guys. Taking forever.
Benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Here we go. Questions?
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and
How
third?
do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, but the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Good, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, and inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of the 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik, the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby. Thank you, Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions
Excellent
if
question.
policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that. And we're not hearing that from companies that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. Yeah. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
Another good question.
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data, we'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just a slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Oh, yeah. So, this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is, let's look, when at this meeting, we're looking back to the July employment report, the August employment report, the 2 CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News.
mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time. As you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well.
He's choosing his words very
the rate
carefully.
At which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Build more homes.
What I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about, is our policy stance where it needs to be to foster over the medium term mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you,
it's getting political.
previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market. And we had inflation way above target. So, that said to us, concentrate on inflation. And we did for a while. And we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision. And I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Thank you.
That wraps up a news conference that probably should have wrapped up 15 minutes ago, live from New York City this afternoon.
Okay, so that was the end of the Jerome Powell press conference there. So I'm just going to do a real quick summary here and just kind of show you guys what I have gathered so far. I really appreciate all of you guys tuning in. And I do want to show you guys some of the new data sort of coming in. But so the Federal Reserve has cut interest rates by 0.5%. And now the Fed funds rate at 4.75 to 5.25%. And it is the first time they cut interest rates in a couple of years here. And we were at the 5.25 to 5.5% since July 2023. And now that the Fed funds rates, well, I wouldn't say unexpectedly, I did expect the Fed to cut interest rates by 50 basis points. Now, what does this mean for everybody else? So let's take a look at what the CME group, I do want to show you this real quick. So the CME is predicting that the next Federal Reserve meeting on November 7th, which is 2 days after the election day, to cut interest rates by another 25 basis points. So there's a 60% probability. And again, these numbers do change almost every day, every hour. So, you can view it like, all right, this is probably what's going to happen. So, but they are projecting another 25 basis point rate cut on November 7th, down to 4.5 to 4.75%. And then for the December 18th Federal Reserve meeting, they are looking at, and the website is extremely slow right now because everybody's on it. But when I was looking at it, there is a 34% chance of cutting another 25 basis point and a 48% chance of cutting the rates to 4 to 4.25%. And this is something that we could see continuously going into 2025 and continue to cut interest rates by either 25 basis points or 50 basis points. And so, this is going to be very interesting because maybe this is all going to depend on the labor data and inflation. So here are some things that you want to be aware of. So today, this is done, Fed announcement, they cut the rates by 50 basis points today. So the next data that we're going to get is September 26th with a third estimate, final estimate for the Q2 GDP. And then we're going to get the advanced estimate on October 30th, which is over a month from today, but we're going to be looking at the Q3 GDP and see how that turned out. If it's weaker than expected, or if it's still strong, like what Jerome Powell has been saying has said during the press conference. And this is a very important data as well. PCE inflation on September 27 and October 31st. Is the 50 basis point rate cut going to flare up inflation again? Or are people spending more money? To me, I don't think so, because this is more going to delay the rate cuts and people shopping. It doesn't mean that people are going to start taking out debt all of a sudden, right? People are still kind of holding fast and say, you know what, I'm going to hold off a little bit and see how much how many more rate cuts they're going to do by the end of 2024. And then I'm going to reassess and see if I'm going to buy a house, or if I'm going to take out a loan, or if I'm going to buy a car or something like that, right? And for CPI, we're also going to have, it's a terrible start there. We're going to have CPI on October 10th, and we're going to have PPI on October 11th. And this is the most important data that he was talking about, is the unemployment on October 4th and November 1st. So write these down on your calendar. October 4th, unemployment data for the September data, and then November 1st will show the October data. No, wait, I think I got it backwards. But you know what? It doesn't matter. It should be correct. And then JOLTS, that's another one, October 1st and 29th. So write those down and on your calendar or whatever, and take a look at. Then we'll get the jobs data for those 2 months before the next Federal Reserve meeting on November 7th. And they were talking about the dot plots a lot. And what I want to show you here is that I know I have some notes over here, but 4.4% was what was brought up during the press conference a lot, right? So right now we're at 4.2%. Now the Federal Reserve, they're predicting that the unemployment rate to be at 4.4% by the end of the year. But if we get 2 more labor data and say, you know what, now that the unemployment rate is already at 4.4 or maybe 4.5% by November, then the Fed could easily cut another 50 basis points, okay? Because they're showing that, wow, this is more of a rising at a rapid pace. Now, what if by December, we get, let's say, 4.6 to maybe 4.7, then they could cut another 25 to 50 basis points. Then they could even be more aggressive with the rate cuts. We'll see about that. And that's what they were talking about. And this, I know it says 4.4 to 4.6, but this could change. It just really depends on the data. And Jerome Powell even said it is very data dependent. So they're going to take one meeting at a time and then reassess and see how that data looks. If unemployment rate came in a lot higher than expected, then they're going to cut rates probably even more. So well, 50 basis points. And this is going to be very, very interesting to see how everything is going to transpire, because the market right now is reacting pretty flat. It's not going up. It's not going down. It was down for a little bit for the S&P 500 and the NASDAQ. And now it's at green about 0.2% and then 0.5% for the NASDAQ. And Dow is up 0.25% or 104 points. So not much changes, which is understandable, because when I look at the 0.5 50 basis point rate cut, right? To me, I'm like, well, this is kind of expected. I think they should have cut in July. And I said that in the last live stream, that they should have cut in July or maybe even June, but they delayed that. And Jerome Powell even said that at the press conference. You know, they wanted to be patient and see how it went. Now the unemployment rate is rising, not rapidly, but steadily, right? Going from 3.9%, 4%, 4.3%, now down to 4.2%. That is concerning. I get that low 4% is still considered healthy, but it's the rate of change that is concerning. When you go from 3.9% up to 4.3%, that is concerning, right? And I talked about the holiday season hiring is going to be a lot weaker than expected from the year prior. Target, Walmart, Costco, they're not going to hire as many people in October, November, and December for the holiday seasons. Those are the things that we want to pay attention to. Those are the things that the Federal Reserve is paying attention to, so that it doesn't become 4.2% to 4.5%, 4.6%, and possibly end the year with 4.7% unemployment rate. Now that would be troubling. No matter who gets elected to the White House, it's still going to be something that the Federal Reserve will have to deal with going into 2025. Now, recession is a concern, and that's something that they brought up and say maybe a recession is going to happen or maybe not. Jerome Powell said, I don't see anything that's indicating a recession right now. A lot of people might disagree with that statement. I'm with them, right? Unemployment is a concern. Inflation has come down, but people's savings rate are still horrendous. People are still spending more money on groceries than they did 2 years ago, 3 years ago. I know the inflation has come down to 3%, 2.5% for CPI, but some items on the grocery items, we're still paying over 30%, 40% from 2 years ago. So that's something that's frustrating the American people, that they are paying way more money than they used to. So that we're going to see how it goes. And I know we have several catalysts coming up with the election coming up on November 5th, and that's 2 days before the next Federal Reserve meeting. Whoever gets elected, that's something that they asked them to, like, are you going to, how do you feel about the Federal Reserve being an independent agency, or, how will you be influenced by the elections and all that? And Jerome Powell said, no, we're going to maintain that independence, and we're going to make our own monetary policy, and while Congress is in charge of fiscal policy. So, but anyway, really good. I thought the press conference was okay. It's nothing crazy. Something else I think we all kind of have to remember is that I'm sure that he prepped those words. There are words that he can't say. He was very careful with what the phrases, and he didn't want to, panic anybody, because when you heard 50 basis point rate cut, right? People are like, well, that's kind of weird. Why are we doing 50 basis point? Is there something that you're not telling us? And so in a way, he kind of reassured reporters, journalists at the press conference that no, there's nothing indicating that there's a recession recession coming. The 50 basis point rate cut is something that we voted on, and then here we are. So we'll see how it goes. Really appreciate you guys tuning in. And this is the major Fed pivot with the rate cut starting today. And I won't be surprised if they continue to cut interest rates going into November, December, and then January. And are they going to cut another 50 basis points, or are they going to just maintain that, maybe go back down to 25? It's really going to depend on the data. But anyway, really appreciate you guys tuning in. Don't forget to get your free resources at firesidechat.com/resources. And this has been another beast of a live stream, and I hope you got a lot out of it.